If you've been trading crypto over the last few days, you've likely watched the price drop, hit the sell button to cut your losses, and then watch the market immediately reverse and rocket higher. You didn't make a mistake. You stepped into a trap that was deliberately set for you. Wall Street market makers are engineering this specific hesitation to shake out retail traders and accumulate their positions at a significant discount. I'm going to show you the exact price level where billions of dollars in short seller liquidity are sitting right now, waiting to be wiped out in the next major move. While retail indicators suggest the rally is over, institutional whales are using these short-term dips as entry points to build massive long positions. Over the weekend, the 4-hour Relative Strength Index, a key momentum indicator, flashed an overbought warning. The metric suggested the market needed to breathe, and the price of Bitcoin printed a few red candles in response. For the average retail trader, an overbought signal on a 4-hour chart triggers immediate panic. They close their longs and open short positions, expecting a massive crash. But the hard data tells a different story. On Friday alone, institutional buyers flooded the market with a massive $663 million in net inflows. A normal day brings in around $100 million. Wall Street bought 6 times that average in a single session. Because the stock market is closed over the weekend, institutions use this downtime. They let the price drift lower on low volume, allowing retail technical indicators to reset, so they can continue building colossal long positions on Monday without spiking the price too early. Going short against the market while institutions are aggressively deploying $500 million a day is a mathematical guarantee that your account will be liquidated. To map exactly where those liquidations will happen, we use a liquidation heat map. Think of this as a financial radar. It shows us the exact price levels where retail short sellers are hiding their stop-loss orders. Looking at this heat map, we see a dense cluster of vulnerability building above the current price, sitting right at $78,500. When the price touches $78,500, those shorts are forced to close, acting as rocket fuel and violently accelerating the price higher. Wall Street knows exactly where that target is, and they have established clear floors to protect their positions along the way. Right now, there is heavy institutional support resting at $75,500. If that level fails during a brief shakeout, a deeper secondary fail-safe base is waiting at the $73,600 mark. Trading alongside these whale movements requires the right execution. I use BingX to navigate these liquidity zones, and if you use the link in the description to sign up, I offer direct one-on-one mentorship to help you set up your own charts. Monitoring these liquidity pools reveals exactly how market makers are positioning themselves, allowing you to anticipate the move before the next squeeze triggers. While Bitcoin sets up its squeeze, the altcoin market is reacting aggressively. Hit the subscribe button right now, because tracking these institutional flows is the only way to know which altcoins are about to explode next. On the 3-day chart, Ethereum is hovering dangerously close to a massive structural breakout above the $2,400 resistance line. If Ethereum can confirm a daily close above $2,400, the structure completely flips, opening up a clear runway straight to the next heavy resistance block at $2,800. XRP, meanwhile, is showing immediate weakness. It recently broke down below its critical $1.45 support floor, turning that previous safety net into a new ceiling of resistance. Solana is currently trapped inside a macro trading range. It has established a hard floor at $75, but faces a massive ceiling at $105. Zooming into the immediate price action, Solana is struggling to break through a heavy, localized resistance wall sitting right between $86 and $90. Altcoins are currently stalling as institutional capital continues to prioritize Bitcoin's liquidity squeeze. Until that move completes, the broader market remains secondary to the sheer volume of these ETF inflows. Chainlink is caught in the exact same pattern, consistently facing harsh rejections at the stubborn resistance lock between $9.50 and $10. The contrast between retail sentiment and institutional data highlights the central rule for this market cycle. Never blindly sell on a short-term momentum warning when macro institutional liquidity is trending upward. Retail traders are getting chopped to pieces trying to scalp 4-hour charts, while whales are calmly accumulating to push Bitcoin into the mid-80K range. Spotting the Bitcoin liquidity magnet protects your portfolio from the initial trap, but surviving the coming weeks means understanding how these sudden moves will shake the altcoin sector. Click the video on your screen right now. I break down the 3 critical mistakes traders are currently making with Solana, and exactly where the smart money is positioning next.